Okay, there we go. First of all, I hope you're all holding up well during this really uncertain time. It's absolutely a new normal for the foreseeable future. I know we're all primarily concerned about our physical health, our family's physical health, followed very closely by concerns with our financial health. What was previously just a healthcare crisis has now turned into a financial crisis as well, something that really hasn't happened in our lifetimes. So without further ado, I want to just go into a little bit about what I do at Ellevest, what we do, and then I'll touch on some market updates, what we're guiding clients to do right now. So I've been in financial services for over a decade. I was previously a financial advisor at Goldman Sachs. I don't know how much you know about Ellevest, but we are a female-focused financial services firm. We are not exclusive to women. We have a lot of women clients, but I'd say about 30 to 40% of our clients are men as well. And especially during this time, this crisis is not discriminating. So I think that we've paused a little bit on some of our, female first, trying to strive for, financial equality for both genders and focus more on what can we all be doing together. Sally Krawcheck is our CEO and founder. I don't know how many of you know her, but she is a woman with a really amazing career on Wall Street. She led some of the biggest firms and some of the biggest wealth management divisions and private banks. And she really started Ellevest to give women a way to feel more comfortable investing. The traditional investing industry has been for men, by men. Something like 86% of financial advisors are men. And so even though women have access to money, or maybe might be the breadwinners in their family, they don't necessarily feel as though it's, the most approachable industry to find someone they want to work with. So when Sally started Ellevest, she started it as a digital platform just to get women invested. Go online, log on, you can invest any sum of money over $0. Truly, there are accounts with $5 in them. But this just allows women to kind of start dipping their toes into something that's not that comfortable. As we've grown and as we've expanded our service offerings, about 2 years ago, we started the Private Wealth Group, which is where I sit and I focus the majority of my time as a financial advisor. So on the digital side, you can go online and open an account and we will allocate your portfolio for you and diversify it for you based on the goals you tell us and your time horizon and any information you can share with us. On the private wealth side, I work with my clients one-on-one. And so I would say, how much are we looking to invest? We start on the private wealth side at $1 million of investable assets with Ellevest. And they're really looking for a one-on-one financial advisor. They're looking for someone to help them construct a customized portfolio, think about, tax efficient strategies, think about getting invested in alternative investments, all those types of things. So we have the same kind of investing philosophy across both pieces of the business, but one is just a bit more automated, computer driven, and one is working one-on-one with someone like myself. I will also add that all of our financial advisors are women, not necessarily by design. It's just who's been attracted to working at Ellevest. And we're located around the country. So working from home is not super new for us. We're always kind of on the road meeting our clients. A quick bit about our investing philosophy that I always like to tell clients, but especially now throughout this market pullback, we always stress the importance of diversification. And I'm sure you all generally know what that means, but really don't put all your eggs in one basket. Diversification is the way that we allocate a portfolio for our clients. And that means we put some portion into stocks or equities, some portion into bonds or fixed income, and some portion into alternative investments. I'm not going to go super deep into alternative investments, but if you have any questions about the alternatives that we offer or why we'd include alternatives in a portfolio, absolutely let me know. It's just for the purposes of this, probably not what we need to focus on today. But just some very general basics, and I'm sure many of you already know this, but stocks or equities are what we think of as the growth portion of your portfolio. While markets are down right now, typically the longer time horizon you have until you need to access the money and the more risk you'd like to take on, the larger of an allocation you'd have to stocks. Bonds, on the other hand, I think of as I call it the sleep well portion of your money, that portion that you want to preserve that capital at night when you're up worried about these crazy headlines, that's pretty safe sitting there. The closer you are to retirement or maybe a goal, like a home down payment or something like that, the more heavily you would weight your portfolio towards bonds. these are discussions I have with my clients before I construct a portfolio. This is something we talk about in one of our first conversations. And this idea of diversification is really a guiding light in investing in general, but even more so now, if you maybe had taken on more risk than you were comfortable with, you'd really be feeling those effects right now. You'd really be saying, wow, I bit off a little more than I can chew and I put too much into stocks. So we really see in all times, in all market conditions, but especially now, the importance of having a well-balanced, diversified portfolio. I can use my own investment portfolio as an example. My stocks are down something like 25%. Doesn't feel great. But my bonds are pretty much flat. They're pretty much down zero. So that balances out the overall risk in my portfolio, bringing it down only about 17%. Again, doesn't feel great, but it's better than being down 25%. So having some portion that I feel comfortable with in a safer asset overall gives me a less risky portfolio. So what are we telling clients to do right now? Quite honestly, if you have a diversified long-term portfolio, and long-term we think of as over 10 years, and you're happy with the investment advice you're getting, you're happy with what, you know, an advisor is telling you or how you're managing it yourself or anything like that, we've been telling clients, stay put. I know it's hard to say like, wait, don't do anything. I'm not supposed to do anything. But any action that you take today will take paper losses and turn them into realized losses. So the market's down 30%, 25%, you're realizing those losses by selling right now. However, if you do have cash to put to work, cash that you've been meaning to invest, we call it sitting on the sidelines, you know, waiting for a market pullback to get money invested, this is actually a really good time to think about start investing that. Another question I get a lot is this the bottom? Is this the lowest we're going to go? You know what? My answer is we don't know. No one really knows. People can make predictions, but it is impossible to time the market. It makes sense maybe then to come up with something like a phased approach where you can gently ease into the market. We call this a dollar cost averaging strategy, where say you have a certain pool of cash that you'd like to start investing or add to a portfolio, maybe break it up into 3 buckets and say, I'm gonna, on 3 separate dates in the very near future, invest a third, a third, a third. And this is just a systematic way of investing. It's a disciplined way to do it. We recommend this even in not crazy market environments, but maybe we'd recommend it over a period of 3 months if volatility was low. Right now, I'm telling clients to shorten that timeline, to bring it down to maybe 4 weeks or 6 weeks and say, okay, on this date, I'm going to invest a third. On this date, 2 weeks out, I'm going to invest the next third. And 2 weeks from there, I'm going to invest that third and final piece. Don't overthink this. Don't try to get fancy about picking the day. Okay, Trump is going to make an announcement this night, or they're coming out. I think the vaccine is going to be ready this day. That's really hard to do. And not even experts can consistently time the market. We often tell our clients, and we stress to them in times of volatility, your time in the market, so the length of time you can put your money into investments and stay patient with it, is far more indicative of how you'll perform than your timing of the market. So trying to pick the best day when the lows are going to be the absolute lowest, nearly impossible. It's only really in hindsight that we know what the lowest day was. So I think that really understanding that all these people you see on CNBC calling the bottom, saying this stuff, that's something they can't really tell until, you know, maybe months out, years out. So getting your money invested, if there's money that you're thinking of putting into the market, now is a good time to do it, because the length of time you have it in there is more important than the day you choose to do it. Another question I've been getting a lot is, should I be rebalancing my portfolio right now? Things feel really out of whack. So as we see the dust begin to settle from this crisis, this pandemic, we will be rebalancing our clients' portfolios. And what that really means is I've already put together for my clients this strategic long-term allocation that I have no intent on modifying unless necessary. Necessary is a change in financial circumstance, a loss of salary, a major financial change. So due to market conditions, there may be a major financial change in their portfolio. If maybe the percentage of equities falls outside of my recommended range, I'd rebalance. I'm not going to make a knee-jerk reaction today, next week, probably the week after. I might wait a little bit though, because what we're seeing right now is a roller coaster. We're seeing ups, downs, that if you decide to rebalance and you overcorrect, you may be too heavily weighted towards something. So this volatility is something we're going to have to ride out. And so we will rebalance, but maybe that point in time is looking something like several weeks out and not the very, very imminent future. So pump the brakes, consider rebalancing if your portfolio gets really out of alignment or outside of the recommended range you think you should have. But we'd like to see the volatility start to stabilize a little bit before we have these kind of knee-jerk, let's buy this, let's sell this. When people get nervous in times like these, and of course everyone is nervous, I like to frame it this way. As an investor, you have to endure some periods of weakness to ultimately get growth. So you need to have some exposure to the equity markets in order to see your investments grow over time. You can't just be solely focused in a full bond portfolio if you're hoping to see some growth. That may mean that in some years, having exposure to equities is going to mean that your portfolio is going to be down. So this year, your portfolio may be down, and that's okay. Every year is not going to be an up year. And before I start working with anyone, I say, again, what are your goals? What are you intending to do with this money? What is it for? If it's retirement and you're in your 30s, you have a long time to weather this financial downturn. If you're thinking about buying a home in the next 2 years, that's a different intended use for that money. And it probably shouldn't be just sitting in the market watching the volatility go up and down. It should be much more heavily weighted towards bonds, perhaps, or it should be held in a large portion in cash. At this point, with the declines we've seen, it's really too late to be recalibrating now to say, oh my gosh, I took on way too much risk. These are conversations you need to have up front before you even start investing. And I know that's hard to hear now, but what we can do is if you've felt some really serious losses and you feel as though you're overexposed right now, be patient. Let's wait for a recovery. We know that there will be a recovery coming, and just stay tight. I know it's a hard thing to kind of swallow right now. Something that I always like to address is an emergency fund. It's not something we talk about every time when I speak to my clients. I usually, assume that people have some sort of emergency savings set aside, but I think it's so important now more than ever. It's a really great thing to think about and a good thing to start kind of socking away even before you put money towards investments. We typically call it about 3 to 6 months of your take-home pay, because typically if you were to lose your income or a salary or some kind of financial income stream, you wouldn't have a ton of time to kind of adjust your budget or the fixed costs that you have. So instead of saying 3 to 6 months of living expenses, we say 3 to 6 months of your take-home pay should be set aside, not in an investment account. It should be set aside in a savings account. It should be readily accessible. It should be sitting there waiting so that you can draw down on it to pay rent or mortgage, groceries, utility bills, tuition, childcare, things that you need to maintain for that 3 to 6 month time span. And typically, again, this is a really strange environment right now with a lot of unemployment and record numbers of unemployment. But typically when we look at historical numbers, unemployment lasts about 3 to 4 months before people find another job. So that's why we say about 3 to 6 months is like a nice, comfortable buffer. Some market updates, some things that we are seeing in the markets, how we're reading them, and what we're telling clients to do. So this has been the fastest bear market in history. A bear market is defined as a 20% decline from recent highs. That is its technical definition. And this marks the end of an 11-year bull market run, which was the longest in US history. This bear market occurred in just 21 days, making it seem far more drastic than other declines in recent history. For reference, the crash of 1987 took 55 days, and the recession in 2008 and 2009 took 274 days. So the quickness with which the market fell, I mean, our lives look drastically different than they did on March 3rd, right? Like we are seeing something that really hasn't been felt before. We kind of think of every recession being the same and different, right? Different causes, but whatever the cause is, once confidence falls and the markets drop, all that matters is the policy response. We saw a truly historic stimulus plan announced last week. But when we think about the beginning of this year, we were on really stable footing. We had low unemployment, we had rising wages, we had strong housing numbers, but now the world is drastically different. So this response plan that the government has come up with is really also driving a lot of market moves. When they announced, when they passed, we saw a big jump in the market. Right now, because we're in this recessionary environment, I think one thing we can forecast for sure is lower GDP, lower consumption rates across many industries. There are some industries that are virtually unrecognizable from what they were a month ago. Open Table, the reservation website is basically 100% down. I think that's something they never saw coming unless something like this happened, right? So there are industries that are completely different than they were 30, 60 days ago. The declines over the past few weeks have been across asset classes as investors have rushed to cash, which means that the declines have been really liquidity driven and not necessarily driven by fundamentals, I would say. So this actually looks a little different than it does in 2008. And everyone's reading this a little differently, but this is our take on it. We think that you have some reason to temper your fears that it is not exactly like 2008, because right now the world's major banking institutions are far better able to weather the shocks than they were in 2008. The underlying plumbing, I would call it, that keeps markets moving has yet to show signs of seizure that characterized the global financial crisis. So banks are half as heavily leveraged as they were in 2008. And 2008 is really what we would consider a systemic failure in the banking system. Right now, there's really no systemic risk. The government is intervening to help stabilize markets. We'll see how that plays out. But right now, it's not the banks that are in so much danger of failing. It's more extraneous forces. It's not the banking industry itself that's on the verge of collapse as it was in 2008. We've seen really historic numbers, I mentioned, in unemployment. That is probably going to be the hardest thing to overcome once we eventually are out of lockdown and out of this, pandemic mode. But the good news is there are some industries that are actually creating jobs. The healthcare industry, pulling nurses and doctors out of retirement or out of non-working status to come back. Pharmaceutical numbers have been up, grocery store workers, delivery workers, shipping and logistics numbers have been up. Those are all positive things. But the record unemployment is just staggering. So those are effects we really don't know how they will play out. Stocks are still down more than 20% off of the February highs. I keep saying February in hindsight was a really good month and none of us knew it at the time. But the VIX, which is a common measure of future stock market risk, is at the same levels it was in 2008. That is a way to gauge how just wild the market has been. I think last week it hit 85, which in normal times, very low volatility times, it's more like 11 or 12, 13. 85 is just an unprecedented number. So, yes, again, these are uncertain times, but waiting until you're certain that the recession has ended and a recovery is on the way is not only impossible, but it's historically very, very costly. So we don't know when or what kind of recovery this will be, but what we do know from history is that investing through the crisis, through a recession, through a recovery has been a successful strategy in the long term. So the other thing that I would say we're looking at in terms of recovery, again, we don't have a crystal ball, but in 2008, it took anywhere from 3 to 5 years for a portfolio to recover. Right now, we're seeing that to be, we think, a portfolio would recover in 12 to 18 months. We're seeing a much shorter recovery period from this crisis. So again, doesn't feel great to be down, but there are some reasons to think that this is a bit different than what we've seen in the past. So please feel free to ask any questions. I'm happy to answer them. I don't, let me see if anything, thank you, Kathy. If you have any questions, just let me know.
I actually had a question for a potential 25-year-old just kind of figuring his way out, if that's okay.
Of course.
So I recently, it's not so much super related to the current conditions, but I just switched over into a new job a couple of weeks ago, and I'm considering moving over or rolling over my Roth into a new retirement plan. But I had a couple of friends recommending to not go towards a time-based plan, you know, like 2060 is, I think, my estimated time of retirement. And he was recommending more look towards, you know, like specific indexes towards the S&P, which have lower expense ratios over time. I was kind of curious what your perspective is on that.
So I think if it is, and I'm not like a retirement expert on this, because typically we actually don't, we work with retirement funds, but not like 401ks. 401k is typically kept at your own firm. I think that that's actually not a bad recommendation. If it is a 401k at your current employer, a target date fund is totally acceptable and usually one of the better options than kind of managing it yourself. On the other hand, if it's something that you're rolling over, so you're done with that last job, you have control of this, I would take it out of the custodian where your old job had it, because a lot of times it's just really easy to lose focus of it, to, you know, you might not remember how to log in, like literal logistical things that start to get really complicated and annoying if you haven't worked there in 5 or 10 years. But putting it into, we always use, for the majority, for when we invest for our clients, we use exchange traded funds, ETFs, and those tend to be, as I think you were mentioning, very low cost. They're passive strategies, and they really track the markets. So right now they'd be down because it's really, you know, we're feeling it across, you know, the entire equities market, that things are down anywhere from 20 to 30%. But historically, we've seen growth of about 10% in the equity market. So, you know, we see over time, it's a great strategy to have these very low cost, very passive investments. They, the longer you can hold them, you know, the better tax benefit. You know, don't sell them quickly, don't move in and out of them quickly. It should really be a buy and hold strategy, and very heavily weighted towards equities. There's also bond ETFs too. So
I was just going to ask what your opinion was on that, because I worked at a place where we saw inflows for like well over a year. So I'd be curious if like you thought the muni bond ETFs were like a good vehicle, or just going into other kinds of ETFs that are just total markets.
I think that there's definitely validity in having some exposure to equity ETFs, and then fixed income muni bond ETFs and muni bonds if you can. There's a little bit of a less benefit of holding them as an ETF versus the individual municipal bonds, but I think that that's absolutely a valid strategy. So I would think that, yeah, that would actually be a really good way to get some exposure to municipal bonds too. We also just came out with a piece on municipal bonds. If anybody's interested in checking out our website, ellevest.com, we have a digital magazine. It sounds a little hokey, a digital magazine, but it's been working really well right now. And we have some really timely articles, one of which we just came out with yesterday or the day before, on municipal bonds, how they will fare in this environment with maybe people having a cut in income or reduced entirely income, being able to pay their taxes. Can then the municipalities afford some of the bonds that they were guaranteeing? So it's an interesting thing to look into right now, and make sure you're only buying really high quality municipal bonds. Right now, it's just too risky in some of these municipalities that may not be able to afford those high yield municipal bonds that they were once guaranteeing.
So Cameron, thank you for your questions. Molly, can you take a look at our chat?
Yes,
and
sorry.
answer some of those? If you scroll up a little bit, you'll see there's one from Alexis that kind of starts the chat questions.
Perfect. Okay. What are the steps to take if I want to start investing through Ellevest with a small amount? Actually, that's really easy on ellevest.com. You essentially create an account. You can transfer money from anywhere, a checking account, a different investment account. It's very user friendly. You'll answer a series of questions about yourself, your time horizon. You can set your goals. You can be a retirement goal, build wealth, children, and those signal to us different time horizons. So we allocate them a little bit differently. And then you can regularly add to that via a deposit, via a paycheck. There are different ways to continually add to that. And we recommend that that is one of the kind of best ways to continue to grow your investment portfolio, just to have a disciplined approach to say, okay, every paycheck is going to have this 5% go into my investment account, because you don't have to think about it. You don't have to think about how much am I setting aside, how much am I, not going to spend on something else. And so that's a really easy way to do it. And it's hopefully very user friendly. If I can do it, I think everyone can do it. It's very they try to make it as client friendly as possible. So it's
and is there a minimum to start with?
For the Ellevest digital platform, there is no minimum. It is $0. And it is a very small cost as well. It's about 25 basis points, which is very, very inexpensive and very, I'd say across the industry, there are a lot of other, I call them robo advisors. Wealthfront, there's another one, Betterment, we come up against a lot. Check them out too. They're going to be the same price in terms of the fees that they're charging.
Okay, thank you.
Of course. And then Holly asked, do you have a fund that invests in private equity firms? So we don't invest in other firms, in other funds right now. What we do offer on the alternative side, though, for our private wealth clients is, so I mentioned stock, some portion to stocks, some portion to bonds, some to alternative investments. We have an alternatives platform where we make private equity, private debt, real estate funds available to our clients. And all of those have a social impact mandate, meaning some of them are gender lens focused, investing in women. Some of them are healthcare focused. Some of them are climate change and clean energy focused. We have one that invests in affordable housing. We actually have two that invest in affordable housing. So all of our alternatives, and this is again, just on the private wealth side, those are usually private funds, private equity, private debt, or real estate is a big one too, with some social impact mandate. So that is we're a mission-driven firm. So we're trying to support women, again, not exclusive to women, but so a lot of our underlying investments can be kind of geared towards directing dollars towards women-owned businesses or companies that support women or have great maternity leave policies or women in management, that type of thing.
So I have one question about how do I encourage, I have a 24-year-old daughter who is back from China and has just started a job. What would you recommend a percent be for her to get started, or a lump sum plus an event, like a percentage of her take home?
That's a great question. So this is going to be a little different for everyone, and your daughter's really young, but kind of skew this to however you feel is like the what you can afford, and what you can realistically, keep up. We typically say of your take-home pay, so whether that's your paycheck every month, people get paid differently, right? Some people get paid on commission, so having a bi-weekly or monthly salary might be a little hard to think about, but your take-home pay, 80% should go towards the current you, I guess is how we call it. Well, the 20% should go towards the future you. So 80% goes towards your bills, your utilities, whatever you have to pay. And again, you can skew it down. If you're like, my living expenses are minimal right now, like I can skew that down, great. Whereas the 20%, we first recommend pay down any high interest debt. There's student loan debt right now. Obviously that's a little bit different. It's being paused, I think for 6 months or so. But if you have any high interest debt, anything that's over 10%, pay that down. If you don't have the emergency fund yet, put the money into it. then take that 20% and start investing in the future you. That again is a really kind of general formula, but, and maybe as you get towards retirement, you say, I'm going to start cutting down my current self. You know, I'm going to have less daily expenses and more, I'm going to put more into my future. But that's a really good starting point, and seeing where you can just systematically get that money into your future you in any way possible. Because if it's systematic, it's less of a choice you have to make every paycheck or every income cycle, whatever that is, to say like, oh, I'm going to spend this on that treat for myself, or I'm going to do something fun with it. It's easier to just say, nope, that 20% is going towards my investment portfolio.
So right now, guys, I'm going to stop the recording after Molly just sort of signs herself out, but we're all going to stay on to chat if we'd like. And you can ask Molly further questions. So Molly, want to close it down?
Yes. So thank you all for joining so much. Again, if you want to get in touch with me, my email is myoung@ellevest.com. I really appreciate you all joining for understanding the volatility of the markets. And if you have any follow-up questions, don't hesitate to reach out.
Thanks, Molly.